first loss default guarantee. This is actually a very interesting thing that is followed in the banking economy of any country. And in India, this is also followed. And here, let us break down the terms. See, first means, first obviously. Then loss means something pertaining to financial loss of any company, of an institution. So, it can be a loss with respect to financial property. Then, default. Default means, suppose you have taken a loan, right? And you are not able to pay it back. So, you are doing what? You are defaulting on the loan. You are not even paying back the, say, principal. Neither you are paying back the interest. So, this is a case of default. And according to default, there are various other classifications of defaulted loans, such as, say, stressed assets, NPA or non-performing assets, and so on. Without going into those, we have to understand default simply means you are not able to pay back the loan that you have taken. And guarantee always means some backup, right? Guarantee means some backup. For example, say you are preparing for your civil service examinations. Maybe some of you have taken a year gap from your education, from your work experience. Now, you have to convince your parents, right? You have to give some guarantee to your parents that you can do it. You have to also give yourself the guarantee that you can do it. That guarantee, right, is that trust, that backup that the people have in some of the things. For example, your parents have in you, you have guarantee in yourself that you can definitely crack it, and obviously you can crack it. So, guarantee is that sole backup that, for example, if you are taking any loan, right, say you are taking a loan of 100 rupees, the guarantee for this can be, say, of 50 rupees, right? For example, if you are taking a loan of 100 rupees, you can place 50 rupees of gold with the bank as a guarantee, right? For example, sometimes the guarantee can also be a company also. A company, when it is taking 100 rupees loans, maybe sometimes it cannot even place a collateral, in this case this gold. Because the company is so reputed, the banks definitely feel that it can pay back, right? So guarantee with respect to loans are this collateral that the people are keeping instead while they are taking loans. Now, here, before understanding more, we have to understand what are lending service providers. See, lending service providers are in present context some very popular fintech companies. This some of the examples of fintech companies, for example, maybe Jupiter Banks, for example, Lazy Pay, for example, Simple. So they do what? They offer some credit card facilities, they offer some credit facilities, they offer some bank and even some credit facilities. But the thing is that they try to give small loans or credit to some people, right? To some people, this can be, say, migrant laborers, this can be, say, students, which are their biggest customers, right? This can be, say, self-employed people also. This can be giving these loans in some credit to even some salaried people also. But the thing is that they are using, say, complex, sophisticated software algorithms to exist on a smart digital medium, so on a smartphone, on websites, but they do not have a bank license, right? They do not have a bank license. On the other hand, banks like, say, ICICI, HDFC, they have a bank license, they have enough money to give, but often the case with them is that they do not have that customer base, which these fintech companies have, because they give varieties of advertisements on, say, Play Store, on, say, various digital medium, right? Google, they try to advertise their service products and they can get customers. While other banks, they struggle to have customers, but they have enough money. So, lending service providers, they do what? They collaborated with banks. Banks plus lending service providers. So, they collaborate with the banks and they ask loans from the banks. And these loans are actually given to these people. So indirectly, what is the thing here? The banks are giving the loans to migrant laborers, students, self-employed, salaried people, but they are acting in the middle, right? They are acting in the middle as an intermediary. In case, say a migrant worker has taken a loan of around 400 rupees. If the migrant worker is not able to pay back that loan, what will this bank do? Will it go to that migrant laborer? No, because the migrant laborer has registered on the lending service provider, for example, on Simple platform. So the bank will be catching Simple then, right? So in this manner, we have to understand this LSP are the middlemen who take loans from the banks and give loans to the customers. If the customers default on any loan, on anything, the banks will not be liable, because then the LSPs will have to pay back that proportion of the loan to the banks, and the LSPs can say, if these customers are not paying back on time, what I can do, I can pay a fixed percentage of the loan back to you. Now you will be thinking the banks were actually better off earlier without the LSPs, because even with less customers, they could have given loan to some few customers. But the thing is that these people on these LSPs are huge in numbers, in millions and crores of people. Now the banks are seeing this as customer acquisition portfolios. So they are seeing these as opportunities for them to expand their business. On the other hand, LSPs are also doing the same. They are expanding their business. So here, in this way, the thing is operating in India. There are many apps like this who do these kind of things in collaboration with the banks. These are not illegal things. But the thing is that this is the arrangement here, right? And this can be done by banks. This can be done with the banks or the NBFCs also here. So the thing is that the RBI right now has said that right now the default first loss guarantee will be given to these people, to banks, non-banking finance corporations and lending service providers, because these are the people who are involved in this arrangement, right? But the thing is that it is allowing now, because earlier the RBI did not allow it. Why? Because there were some lapses in regulations. There were some lapses in the regulation. It was sometimes happening outside RBI's regulations. Right? According to a 2021 report, it was observed that in some cases, these fintech companies were undertaking balance sheet lending in partnership with a bank or NBFC or on a standalone basis. That means it is not following the RBI's norms of giving loans properly, right? Without getting into this balance sheet, debacles, issues. Let us understand very simply that they were not simply following the regulations of giving some loans to the people. Correct? Then the RBI issued guidelines on digital lending in September 2022, but did not give clarified to this kind of lending structure. Right? So in there, if you do not give laws, if you do not give regulations, then naturally these people will be operating without the hand of the law. So that is why the RBI introduced this thing. And when RBI introduced this thing, it will be becoming something which is legal, and here there must be separate rules and regulations and restrictions that they have to follow. For example, say it can be the thing that the interest rates on, say, migrant labor, students, salaried, self-employed, they can come under RBI's regulation. The amount of loans, the limit of loans, the limit of credit that they can give to the people, they can also come under regulation. So these are the things, right? These are the things which will be which is understandable that it is having a significance, that it will be facilitating all the players to participate. Correct? And it will be also facilitating the entry of small and medium fintech companies also. Because according to RBI's guidelines, right, they must be, the lending service providers, they must be enrolled under the Companies Act of 2013. So they must be properly registered as a company in India. Right? They have to be registered as a company in India. Then the RBI have allowed the banks to accept DLGs in lending only if the guarantee is in the form of cash, deposit or fixed deposits in a bank. Remember the structure we have taught? Banks, LDGs, right? And finally the people. If the people default, the LDG is responsible. But how it is responsible? it has to be responsible in cases of very liquid assets. That means if the loan is defaulted, they have to pay back in form of, say, fixed deposit, cash to the banks, right? Now, banks and NBFC should ensure that the total amount of DLG cover of any outstanding portfolio does not exceed 5% of the amount of that loan portfolio, right? So it should not exceed 5% of the loan portfolio. That is the thing that they have to, the banks and NBFCs have to ensure.